Welcome to the Deep Dive, where we help you get smart on the topics that really matter. Today we're diving into Stantec's Q2 2025 results. They're a global leader in sustainable design and engineering. We'll unpack the numbers, their strategy, and what the leadership team that CEO Gord Johnston and CFO Vito Culmone had to say.
Yeah, it's a really interesting one because, the market's first reaction, it seemed kind of disconnected from what looked like a pretty solid quarter on paper.
Absolutely. That's definitely something we need to explore. So maybe let's start with those headline figures first. They kind of set the scene.
Good idea. So bottom line first, adjusted diluted EPS, that's earnings per share, tweaked for a clearer view of core profits, landed at $36 for the quarter.
Okay, $36. How does that stack up?
Well, it was up a strong 21% from last year, and it perfectly matched what analysts were expecting. So yeah, a solid beat on earnings.
Right, and profitability. Margins are always key. How do they look?
Very strong there too. We saw some significant margin expansion. Their adjusted EBITDA, earnings before interest, taxes, depreciation, amortization, that operating performance measure, that jumped 15% to $284.4 million. And crucially, the margin itself, it widened by 120 basis points.
So 1.2% higher.
Exactly, hitting an impressive 17.8%. That really points to some very disciplined operations.
Okay, strong earnings, better margins. But there was one number that maybe didn't quite hit the mark.
Great.
Gave the market pause.
Yeah, that seems to be it. The net revenue, it came in at $1.60 billion. Now, that was up almost 7% year over year, which is good.
But
it slightly missed the $1.64 billion analysts were forecasting. It's not a huge miss, but, sometimes that's enough to influence that initial reaction we saw.
Makes sense. So despite that small revenue miss, if you look underneath, how's the overall financial health?
Looks very robust, actually. Operating cash flow, way up, increased by nearly 80% compared to last year, hitting $134.0 million for Q2.
Wow, 80%.
Yeah. And their days sales outstanding, or a DSO, how fast they collect cash, was super efficient at 73 days.
Better than their target.
Yeah, well below their internal goal of 80 days. Shows really tight cash management. And their debt levels look comfortable too. Net debt to adjusted EBITDA ratio is healthy at 1.1 times.
So well within their comfort zone.
Absolutely, well within their target range.
Okay, and looking ahead, what about future work? Is the pipeline strong?
Definitely. Their contract backlog, it grew almost 10% year over year, hitting $7.9 billion.
$7.9 billion. How much work is that?
It represents about 12 months of work for them. And what's really encouraging is that about 9% of that growth was organic.
From their existing business, not just buying companies.
Exactly. So that gives them, really good visibility into future revenue, a pretty clear picture of what's coming down the pike.
Okay, so we've got strong earnings, great margins, healthy balance sheet, solid backlog. But that slight revenue miss. Let's dig into that margin expansion a bit more. What really drove that improvement?
Well, what's interesting is it wasn't just about revenue growth pushing margins up. It was more about cost control. Specifically, lower admin and marketing costs as a percentage of revenue.
Did they manage that?
Seems like it was partly due to lower claim provisions, but also just really disciplined spending on discretionary items. They also mentioned getting more out of their workforce, higher utilization, and scaling their back office support more slowly than revenue grew.
Smart management then.
Yeah, really points to efficient cost control across the board.
They also talked about broad-based organic growth. Where were the real bright spots?
Oh, the water business unit was definitely a major highlight. It posted, get this, 12.4% organic growth.
12.4%. That's huge for infrastructure.
It really is. They saw double-digit organic growth in the UK, Australia, and New Zealand, mostly thanks to long-term framework deals. And in Canada, an incredible 30% organic growth.
30%. What's driving that?
Major wastewater projects mainly. Then you had energy and resources also doing well, high single-digit organic growth. That was boosted by a big hydropower GAM project ramping up in the U.S. Southwest.
Right.
And also copper mining projects down in Latin America, which, ties into the whole energy transition theme. Even the U.S., despite some procurement slowness we'll touch on, showed better organic trends than Q1, especially in buildings, healthcare, science, and tech, that kind of thing.
Okay, so broad strength. Now, they've also been busy with M&A, right? Buying other companies. What were the key deals?
They were quite active, yeah. 3 main ones recently. The biggest was closing the deal for Page at the end of July. That's a pretty large U.S.-based architecture and engineering firm, about 1,400 people.
What does Page bring to the table?
It really boosts their presence in some hot sectors. Think healthcare, advanced manufacturing, data centers, and also specialized academic science and tech facilities. So a very strategic move for future growth areas.
And there were others earlier in Q2.
That's right. They bought Ryan Hanley over in Ireland, which strengthens their position in the Irish water market. And they also acquired Cosgroves in New Zealand, adding more building engineering expertise there.
So quite a few new people joining.
Yeah. Altogether, those added about 1,500 staff, pushing Stantec's total headcount over 34,000 globally. And management seems confident they can get most of the integration work for these deals done by year-end.
That's pretty fast. Let's talk balance sheet again. You mentioned healthy debt, but what else did they do there?
Well, they did a couple of important things. They issued $425 million in new bonds, senior unsecured notes at a decent rate, 4.374% for 7 years. And importantly, they got an investment-grade credit rating on that.
Which signals stability to lenders.
Exactly. And they also beefed up their main credit line, their unsecured revolver, increased it from $800 million to $1.2 billion, and pushed out the maturity date.
So plenty of financial flexibility.
Loads. Even after paying for Page, they've got over $1 billion in available credit remaining. It really positions them well if they want to make more acquisitions down the road. Lots of dry powder.
Okay. Strong operations, strategic buys, solid finances. How does this translate into their outlook for the full year? You mentioned the market reaction, but did management actually raise their forecast?
They did, yeah. Quite significantly across the board, really. They pointed to the strong first half and the impact of those recent acquisitions.
So what are the new numbers?
Okay, so for net revenue growth, they're now expecting 10-12% for the year. That's up from 7-10% before.
Nice bump.
Yeah. Adjusted EBITDA margin guidance is now 17.4%, up from 17.3%. And adjusted EPS growth is now forecast at 18.5 to 21.5%, which is a big jump from the previous 19%.
So that implies they're hitting some longer-term goals early.
Exactly. This new guidance suggests they expect to hit their big strategic plan target for EBITDA margin, that's 17-18% range, a full year ahead of schedule.
Very impressive. But you hinted earlier maybe a slight caution on the U.S. side. What was that about?
Right. So while the overall picture is brighter, they did slightly trim the U.S. organic growth outlook just for this year, down to mid-single digits.
Why the trim?
They put it down mostly to slower public sector procurement cycles, said there have been some delays in getting projects approved, partly because of, believe it or not, retirements at some government agencies, just slowing things down a bit temporarily.
Interesting. So just a timing issue, not a demand issue. They're not seeing less interest in projects overall in the U.S.
No, not at all. Management was pretty clear they expect U.S. organic growth to pick back up, to accelerate, actually, in the second half of the year. And they backed that up by pointing to a really healthy U.S. organic backlog that's up almost 10% year over year.
Okay, so the U.S. work is booked, just taking a bit longer to kick off. What about other regions?
Canada and their global operations are expected to keep humming along with mid to high single-digit organic growth. They see benefits from the big UK water investment cycle, the AMP frameworks, and continued tailwinds from energy transition projects like the copper mining in the LATAM and other new things in Europe.
And they addressed that Thames Water situation in the UK too, right?
They did. Since Thames Water is a long-standing client, they wanted to reassure investors. Basically said, look, the work needs doing regardless of Thames' financial issues, and Stantec isn't having any problems getting paid.
Got it. So it feels like despite maybe some near-term timing stuff in the US, the big picture trends are still very favorable for them.
Oh, absolutely. The core drivers are incredibly strong. You've got aging infrastructure everywhere needing upgrades, the explosion in data centers, the push for energy security, critical water and wastewater needs, healthcare demands, plus reshoring manufacturing. These are all powerful long-term trends feeding directly into Stantec's business lines.
And government funding is still flowing.
Yes, very much so. There's still a lot of money left to be allocated from the big U.S. Infrastructure Act, the IIJA, that funding runs through 2026. Plus, you have new 10-year infrastructure plans in the UK and Ireland, and even increased defense spending globally is helping, as a lot of that goes into infrastructure, not just weapons. These are major tailwinds that should last for years.
Okay. Did they talk about technology at all, like AI? How is that playing into their plans?
Yeah, they touched on it. So they're actively exploring AI and other digital tools. They've rolled out things like Microsoft Copilot pretty widely, over 10,000 licenses.
What do they expect AI to do for them?
Well, it's still early days, they emphasize that, but the expectation is it'll help make back office functions like HR and accounts payable more efficient, maybe streamline writing proposals, and eventually help optimize the actual design work. The goal is, using tech to boost efficiency and eventually margins.
Makes sense. And what about those potentially cyclical areas like data centers? Are they getting too exposed there?
They seem comfortable with their current level. Data centers are only about 2-3% of their net revenue right now. They reiterated their target of keeping their total exposure to more cyclical markets like mining and oil and gas included under 15% of revenue overall.
So diversification is still key.
Yeah, they want that resilient revenue mix.
Yeah.
They also mentioned that prices for buying companies, the M&A multiples, have been pretty stable, though maybe a bit higher for firms focused on power and data centers. Suggests they're still seeing opportunities to buy in a busy market.
Okay, so let's circle back to that initial puzzle. Strong numbers, raised guidance. Why the negative stock reaction right after the call? What's your take?
It really seems like the market just got snagged on a couple of things. That very slight revenue miss against consensus and the slight trimming of the near-term U.S. organic growth outlook.
Even though the full-year guidance was up.
Exactly. It looks like those immediate, maybe slightly negative data points initially overshadowed the stronger underlying performance and the significantly improved full-year forecast. It was like the market focused on a potential tiny speed bump instead of the fact that the car was actually accelerating overall. A short-term reaction, perhaps.
So a disconnect between management's confidence in the long term and the market's initial focus on those near-term details.
I think that's a fair way to put it. Management sounds very confident about the U.S. picking up in the second half. They see no reason why their long-term organic growth target of over 7% shouldn't hold through 2026 and beyond. And you can't ignore the strong EPS and margin performance that shows good execution.
Right. They're playing the long game.
Absolutely. Growing scale, moving into higher value areas like water, using their strong balance sheet for smart acquisitions, that seems to be the multi-year plan.
All right, this is the deep dive, and it's time for our This Is Not Financial Advice segment. This is where we toss out a thought experiment, maybe an outrageous but plausible take on the situation, just for fun and education. Remember, always do your own homework.
Okay, let's hear it. What's the angle?
My thought experiment. I'm calling it the Water Wins Big Contrarian Play on Stantec, ticker STN. Thesis is simple. The market majorly overreacted, got completely hung up on a tiny revenue miss and a temporary U.S. procurement lag, like focusing on a brief drizzle when a monsoon's brewing.
Okay.
Meanwhile, Stantec is digging this incredible moat around global water infrastructure. 12.4% organic growth in water, that's massive, plus energy transition tailwinds, the UK water cycle just starting. This isn't just defense, it's structural growth tied to unavoidable global needs.
So the U.S. slowdown is just noise.
Exactly, it's transitory.
Yeah.
My thinking is, when that huge IIJA funding really hits the ground and those agency roles get filled, that massive U.S. backlog, up almost 10% organically, remember, is going to translate into a revenue surge that makes the market look twice.
So the idea is the market blinked.
Totally. It blinked. It missed the powerful long-term currents in water scarcity, infrastructure renewal, energy transition. Buying now in this scenario is betting that the market eventually catches up to the reality of those secular trends. And the Page acquisition just adds more fuel, bringing in those high-growth areas like data centers and advanced manufacturing. Classic case of missing the forest for one slightly shaky tree.
That's definitely a contrarian take on the initial reaction, puts the focus squarely on the long-term trends and the backlog.
Okay, let's wrap this up. To recap, Stantec's Q2 showed really strong execution, right? Delivered good adjusted EPS, expanded margins impressively.
Yeah, supported by that broad organic growth, especially the standout performance in water. And while, yes, there was that slight revenue miss and the moderated near-term U.S. outlook that seemed to cause some initial jitters.
They turned around and significantly raised their full-year guidance and pointed to that very strong backlog.
Exactly. And those strategic acquisitions, plus the strong balance sheet, really position them well to keep growing in these attractive infrastructure and energy transition markets. It's a reminder, I think, that sometimes the market reacts to the immediate headline, but the real story often lies in the bigger picture and the long-term strategy.
Well said. And as always, remember this discussion was for educational purposes only. It is definitely not financial advice. We always encourage you, our listeners, to do your own research and due diligence. Thanks for diving deep with us today.